Welcome to our deep dive into the United Kingdom's economy, tracing its trajectory from the years leading up to the 2008 financial crisis through to the present day. To truly understand the challenges Britain has faced over the past decade and a half, stagnant productivity, rising government debt, and pressures on living standards, we need to start at the beginning. What was the UK economy like before the storm hit? How did its strengths and vulnerabilities set the stage for the crisis that would follow? In the early 2000s, the UK economy was often seen as a model of modern growth and stability. On the surface, the country seemed to have it all: a booming financial sector, a thriving services industry, and a labor market that, for the most part, was flexible and dynamic. London had emerged as a global financial hub, rivaling New York, and British banks were expanding across Europe and the world. Meanwhile, the technology and creative industries were beginning to flourish, providing new sources of economic dynamism. But beneath this veneer of prosperity, there were vulnerabilities that few paid enough attention to at the time. Structural shifts in the economy, rising household debt, and a growing dependence on financial services were quietly reshaping Britain's economic landscape. Let's begin with a look at the structure of the UK economy in the pre-2008 period. Traditionally, Britain had been an industrial powerhouse. The 19th and early 20th centuries saw the rise of manufacturing, from shipbuilding on the Clyde to textile production in Manchester. By the late 20th century, however, deindustrialization had transformed the economic landscape. Manufacturing, once the backbone of the economy, had declined dramatically. The share of manufacturing in GDP fell from around 25% in the 1970s to just over 10% by the early 2000s. In its place, services, particularly financial and professional services, rose to dominate. London became the center of a global financial network, with investment banks, insurance firms, and trading institutions fueling growth. This shift brought high-value jobs and contributed to GDP growth, but it also concentrated economic power and wealth in certain regions. London and the southeast prospered, while large parts of northern England and other industrial regions experienced slower growth, higher unemployment, and a slower pace of recovery from economic shocks. Household consumption, too, was a major driver of growth. Rising property values and easier access to credit created a consumer boom. Families felt wealthier, and spending increased steadily. But much of this prosperity was built on borrowing, not necessarily on increases in productivity or wages. The labor market in the pre-2008 UK economy appeared strong. Unemployment was relatively low by historical standards, hovering around 5% in the mid-2000s. Flexibility in employment laws and a shift toward service sector jobs allowed many to find work, even as manufacturing jobs declined. Yet, beneath these figures, productivity growth was a concern. Productivity, the measure of output per worker, had been slowing since the 1970s, and by the early 2000s, the UK was beginning to lag behind other advanced economies like Germany, France, and the United States. Slower productivity growth meant that wage growth for ordinary workers was modest, despite overall economic expansion. In other words, the economy was growing, but the benefits were not equally shared. The financial sector boom, the pre-crisis UK economy, was heavily influenced by its financial sector. The big four banks, HSBC, Barclays, Royal Bank of Scotland, and Lloyds, expanded aggressively, both domestically and internationally. London's status as a global financial center attracted foreign investment and talent, reinforcing its dominance in the sector. Financial innovations, including complex mortgage-backed securities and other derivative products, were transforming banking. These instruments promised higher returns but also carried higher risks, many of which were poorly understood outside the finance world. Meanwhile, credit availability expanded dramatically. Homebuyers could borrow more easily than ever, and households took on higher levels of debt to fund consumption and property purchases. By 2007, total household debt in the UK had risen to over 130% of disposable income, a historically high level. Property prices were soaring, creating a sense of prosperity and security, yet leaving the economy exposed to shocks if the housing market faltered. Government policy and economic stability. Government policies during this period focused on stability and encouraging growth. The Bank of England, granted operational independence in 1997, managed interest rates and monetary policy with a dual mandate, controlling inflation while supporting economic growth. For the most part, inflation was low and stable, and GDP growth remained relatively steady. Fiscal policy was moderately conservative. The government balanced public investment in services with the need to control budget deficits. However, spending on social services, infrastructure, and public health did not always keep pace with population growth and demand, planting seeds for future challenges. The policy environment encouraged financial innovation and credit expansion. Low interest rates made borrowing cheap, fueling the housing boom and private sector growth. Yet these policies also contributed to rising inequality and left the economy vulnerable to external shocks, particularly in the financial system, consumer behavior, and household debt. Households were central to the pre-crisis economy. Rising property values created a wealth effect, where people felt richer simply because their homes were worth more. This encouraged spending and reinforced economic growth. Consumer confidence was high, and access to credit made it easier for families to finance cars, appliances, and other goods. However, much of this growth was fueled by debt rather than productivity. When you combine high household borrowing with an economy increasingly reliant on finance, any shock to asset prices, like a decline in property values, could have far-reaching consequences. And as we would see, this vulnerability became painfully clear during the 2008 financial crisis. Regional disparities and social implications, even before the crisis, economic inequality and regional disparities were apparent. London and the Southeast benefited most from financial sector growth, with high salaries and rising property values. Northern regions, such as the Northwest and Yorkshire, still faced the legacy of industrial decline, with lower wages and slower job creation. This uneven growth shaped social outcomes, affecting education, health, and long-term opportunity. The economy may have appeared strong on aggregate, but not all citizens felt its benefits. These disparities would become more pronounced in the years following the financial crisis. In summary, the UK economy before 2008 was a mixture of strengths and vulnerabilities. Financial services flourished, GDP growth was steady, and households felt prosperous. Yet underlying this apparent stability were structural weaknesses, slowing productivity, rising household debt, and regional disparities. These factors would soon converge, amplifying the effects of a global financial shock that many believed could never reach British shores. In the next chapter, we will examine the 2008 financial crisis itself, exploring how these vulnerabilities were exposed and the dramatic consequences for the UK banking system, households, and government policy. We'll look at how a global event triggered profound local consequences, setting the stage for the economic challenges that continue to shape Britain today. The 2008 financial crisis causes an immediate impact. The year 2008 marked a turning point for economies around the world. What began as a series of problems in the US housing market quickly escalated into a global financial crisis. For the United Kingdom, the shockwaves were profound. The vulnerabilities that had been quietly building in the pre-2008 economy, high household debt, dependence on financial services, and rising asset prices, were suddenly exposed. Origins of the crisis. To understand the UK experience, it is important to first look at the origins of the global financial crisis. While the crisis is often associated with the collapse of Lehman Brothers in September 2008, its roots go back several years. In the United States, a housing bubble had formed, fueled by easy credit, low interest rates, and financial innovation. Mortgages were increasingly extended to subprime borrowers, individuals with weaker credit histories who were more likely to default. Banks repackaged these mortgages into complex financial products called mortgage-backed securities and collateralized debt obligations, which were then sold to investors around the world. The problem was twofold. First, the underlying mortgages were risky. Second, the financial instruments were so complex that many investors, and even the banks themselves, did not fully understand the risks they were taking on. When housing prices began to fall in the US, defaults rose sharply, and the value of these securities collapsed. The effects rippled through global financial markets, reaching banks, pension funds, and insurance companies worldwide. Exposure of UK banks. The United Kingdom was particularly vulnerable because of its large, internationally connected banking sector. Major banks such as Royal Bank of Scotland, Lloyds, and HBOs had significant exposure to US mortgage-backed securities and other risky financial products. In addition, British banks had engaged in aggressive domestic lending, including mortgages and commercial loans. The housing boom in the UK meant that banks were heavily exposed to the property market. When house prices began to stagnate and then decline in 2007, the value of collateral securing loans dropped, increasing the risk of default. By 2008, the combination of international losses and domestic vulnerabilities put UK banks under extreme stress. In some cases, banks faced insolvency, unable to meet their obligations without government intervention. Immediate impact on the UK economy. The financial crisis had immediate and dramatic effects on the UK economy. Confidence in the banking system plummeted, credit markets froze, and businesses struggled to access funding. Companies that relied on bank loans for daily operations suddenly found themselves unable to secure financing, leading to layoffs, halted investments, and a sharp slowdown in economic activity. Households were also affected. Rising unemployment, falling home prices, and declining stock portfolios created a sense of economic insecurity. Many families faced the threat of foreclosure, particularly those who had taken on large mortgages during the housing boom. Consumer spending, which had been a key driver of growth, contracted sharply. By late 2008, the UK economy was officially in recession. GDP contracted, unemployment rose, and inflationary pressures began to shift as demand fell. The crisis exposed structural weaknesses in the economy and highlighted the risks of relying heavily on financial services and consumer debt for growth. Government intervention, emergency measures. Faced with a rapidly deteriorating financial system, the UK government and the Bank of England took decisive action. One of the most notable measures was the Bank Rescue Package, announced in October 2008. The government provided capital injections into major banks, effectively nationalizing parts of the banking sector to prevent collapse. The Bank of England cut interest rates aggressively from 5% in late 2007 to 0.5% by March 2009. This was accompanied by liquidity support to ensure that banks could continue to lend to businesses and households. At the same time, the government introduced fiscal stimulus measures, including temporary tax relief and increased public spending to support demand. These actions were essential to stabilizing the banking system, but they came at a cost. The interventions significantly increased public debt and created long-term fiscal challenges as the government assumed responsibility for large portions of private sector losses. The housing market collapse. The housing market played a central role in the UK's experience of the crisis. Following years of rapid price growth, house prices peaked in 2007. As the crisis unfolded, prices fell sharply, particularly in regions that had experienced the largest booms. This decline had several effects. First, homeowners with large mortgages found themselves underwater, owing more than their properties were worth. Second, the collapse in property values reduced household wealth and confidence, further suppressing consumer spending. Third, the housing market downturn exposed the fragility of banks' mortgage portfolios, amplifying financial instability. By 2009, house prices in the UK had fallen by roughly 15% from their 2007 peak, marking the largest decline in decades. Recovery would take years, and affordability challenges persisted even as the market stabilized. Business impact and rising unemployment. The credit crunch had a severe impact on UK businesses. Small and medium enterprises, in particular, struggled to secure financing, leading to layoffs and reduced investment. Large companies faced declining demand and tightened credit lines, forcing cost-cutting measures. Unemployment began to rise steadily. By mid-2009, the jobless rate had climbed to over 7%, up from around 5% in 2007. Certain sectors, including construction, manufacturing, and financial services, were disproportionately affected. The recession highlighted the economy's dependence on financial services and the risks of regional disparities, as job losses were concentrated in both industrial regions and urban financial hubs. Consumer behavior and economic confidence. The crisis had a profound psychological impact on households. Consumer confidence fell sharply as people worried about job security, declining home values, and the stability of banks. Spending on non-essential goods and services declined, while saving rates increased. This shift further dampened economic activity. The recession created a feedback loop. Falling confidence reduced spending, which in turn hurt businesses, leading to more layoffs and economic contraction. The crisis demonstrated how interconnected financial stability, consumer behavior, and economic growth truly are. Broader economic consequences, beyond banks, households, and businesses, the financial crisis had wider implications for the UK economy. Public finances were strained as tax revenues fell and spending on unemployment benefits increased. Government borrowing rose dramatically, laying the groundwork for debates about austerity and fiscal responsibility in the years to come. The crisis also exposed structural issues in the UK economy, reliance on financial services, regional disparities, and limited productivity growth. These weaknesses would shape economic policy and debates for the next decade, influencing decisions on everything from banking regulation to infrastructure investment. Lessons from 2008. The 2008 financial crisis taught several important lessons. First, excessive risk-taking in the financial sector can have systemic consequences. Second, household debt, if it grows faster than income, can amplify economic shocks. Third, government intervention, while costly, can be crucial in preventing complete collapse. For the UK, the crisis highlighted the fragility of an economy heavily reliant on finance and property, and the importance of diversifying growth across sectors. It also set the stage for a prolonged period of low productivity growth, slow wage growth, and challenges in public finance that continue to this day. In summary, the 2008 financial crisis was a watershed moment for the United Kingdom. Banks teetered on the edge of collapse, households faced falling property values and rising unemployment, and the government was forced into emergency interventions. The immediate impact was severe, but the long-term effects on productivity, public debt, inequality, and social welfare would unfold over the next decade. Government and central bank response, quantitative easing, and fiscal policy. In the aftermath of the 2008 financial crisis, the United Kingdom faced an unprecedented economic challenge. Banks were on the brink of collapse, households were reeling from falling home values, and businesses struggled to access credit. The government and the Bank of England were forced to act decisively. The tools they used, quantitative easing, interest rate cuts, and fiscal stimulus, would shape the UK economy for years to come. In this chapter, we will explore how these policies were implemented, their immediate effects, and their unintended long-term consequences, including rising asset prices, increasing inequality, and shifts in the structure of the economy. The role of the Bank of England. The Bank of England, which had been granted operational independence in 1997, became the central actor in the UK's post-crisis response. Its primary goals were to stabilize the banking system, ensure liquidity in financial markets, and support economic growth while maintaining price stability. Interest rates, the traditional tool of monetary policy, were cut rapidly. From 5% in late 2007, the bank's base rate fell to 5% by March 2009, a historic low. This reduction was intended to make borrowing cheaper for households and businesses, stimulating spending and investment. However, with banks cautious about lending, traditional interest rate policy was not enough. The financial system was frozen, and the flow of credit had nearly stalled. Something more extraordinary was needed. This is where quantitative easing, or QE, came into play. Understanding quantitative easing. Quantitative easing is a form of monetary policy in which a central bank purchases government bonds or other financial assets to inject money directly into the economy. The goal is to lower long-term interest rates, encourage lending, and stimulate economic activity. In the UK, the Bank of England began QE in March 2009, initially purchasing $75 billion of government bonds. Over the next several years, the program expanded dramatically, eventually reaching over $450 billion. By buying these assets, the bank increased demand for bonds, lowering yields and making borrowing cheaper. For households and businesses, QE had a more indirect effect. While it did not immediately force banks to lend, it helped stabilize financial markets, restored confidence in banks, and reduced the risk of further financial collapse. Fiscal policy response. Alongside monetary policy, the UK government implemented a series of fiscal stimulus measures to support demand in the economy. These included temporary tax cuts, increased government spending on infrastructure and public services, and direct support to struggling industries. The goal was to offset the collapse in private sector spending. For example, public works programs created jobs, while tax relief increased disposable income for households. These interventions helped to prevent the recession from deepening further and laid the groundwork for gradual recovery. However, these policies came with significant trade-offs. Increasing government spending while tax revenues fell led to a sharp rise in public debt. By 2010, government debt had reached levels not seen since the post-World War II period. This would later fuel debates about austerity, fiscal sustainability, and the appropriate balance between stimulus and fiscal discipline. Effects on asset prices. One of the most visible consequences of QE and low interest rates was the rise in asset prices. Stock markets recovered quickly, and property prices began to stabilize and eventually rise again. While this was positive for investors and homeowners, it also highlighted an important side effect: increased inequality. Individuals who owned assets, stocks, bonds, and property benefited the most, while those without significant wealth saw little direct benefit. The policies effectively boosted the value of existing wealth, rather than creating uniform growth across society. This dynamic would become a defining feature of post-crisis economic debates. Growth returned, but not evenly. Supporting the banking sector, the Bank of England and the government also introduced a series of measures specifically targeted at stabilizing banks. Capital injections, guarantees on bank liabilities, and the temporary nationalization of some institutions ensured that banks could continue operating. For example, the government support for the Royal Bank of Scotland involved taking a majority stake in the bank, providing essential liquidity, and restructuring operations to prevent collapse. Similar interventions occurred for Lloyds Banking Group and HBOS. These actions were crucial to preventing a total collapse of the financial system, but they also blurred the line between public and private responsibility, raising questions about moral hazard. If banks are bailed out, will they take excessive risk in the future? Challenges in implementing QE and fiscal stimulus was not without difficulties. Banks were initially hesitant to lend despite low interest rates, reflecting deeper concerns about solvency and borrower risk. Fiscal stimulus programs required careful planning and coordination to ensure that spending reached the sectors and households that needed it most. Moreover, communicating these policies to the public and markets was essential. Confidence, both in the financial system and in the economy more broadly, was as important as the policies themselves. The Bank of England had to manage expectations, signaling that it would act decisively while avoiding panic. Impact on economic growth. These interventions helped stabilize the UK economy. By late 2009 and 2010, recessionary pressures began to ease, and GDP growth returned, albeit modestly. Banks regained some confidence, credit flows gradually resumed, and consumer spending started to pick up. However, the recovery was uneven and slow. Productivity growth remained weak, wage growth lagged, and many households continued to face financial stress. While QE and fiscal stimulus prevented a deeper depression, they did not resolve the structural weaknesses exposed by the crisis. Unintended consequences. The very measures that stabilized the economy also had unintended effects. First, the policies contributed to rising inequality by disproportionately benefiting asset owners. Second, low interest rates encouraged borrowing and risk-taking, potentially sowing the seeds for future financial imbalances. Additionally, long-term public debt increased significantly. While manageable in the short term due to low borrowing costs, these obligations constrained future government policy and fueled debates over austerity in the subsequent decade. Finally, QE and low rates had limited direct impact on productivity growth. Investment in technology, infrastructure, and skills remained inadequate, leaving the UK with persistent structural challenges. Lessons from the policy response. The UK's response to the crisis offers several lessons. First, decisive intervention can prevent catastrophic economic collapse, but it comes with trade-offs. Second, monetary and fiscal tools are powerful, but must be complemented by structural reforms to ensure long-term growth. Third, stabilizing the financial system alone is not enough. Inequality and household vulnerability require parallel attention. The post-crisis era demonstrated that while policy could mitigate immediate damage, It could not fully resolve underlying weaknesses in productivity, public finance, and economic inclusivity. In summary, the government and the Bank of England responded to the 2008 crisis with unprecedented tools. Quantitative easing, low interest rates, fiscal stimulus, and bank rescue stabilized the financial system and prevented a deeper recession. Yet these policies also had long-term consequences, including rising asset prices, increasing inequality, and significant growth in public debt. In the next chapter, we will explore productivity stagnation in the UK. We'll examine why, despite these interventions, the economy struggled to regain strong, sustained growth, and why wages and living standards for many households remain stagnant. This will highlight one of the most persistent challenges facing Britain in the post-crisis era, productivity stagnation since 2008. Despite the extraordinary interventions by the Bank of England and the UK government in the wake of the 2008 financial crisis, the British economy faced a puzzling problem. Productivity growth remained weak. Productivity, the measure of output per worker, is a key determinant of wages, living standards, and long-term economic prosperity. In this chapter, we will explore why productivity stagnated in the UK after 2008, the structural and policy factors behind this trend, and the implications for workers, businesses, and the broader economy. Understanding productivity. Before delving into the causes of stagnation, it is important to understand what productivity is and why it matters. Productivity measures the efficiency with which labor, capital, and technology are used to produce goods and services. When productivity grows, workers can produce more output in the same amount of time, which allows wages to rise without fueling inflation. Historically, productivity growth in the UK had been relatively strong during the post-war period, supporting rising living standards. However, even before the 2008 crisis, growth had been slowing. Between 2000 and 2007, productivity increased at an average annual rate of around 2% compared with 5% or more in earlier decades. After the crisis, this rate collapsed to roughly 0.51% per year, creating what economists have called the productivity puzzle. The impact of the financial crisis. The financial crisis played a central role in stalling productivity growth. During the recession of 2008-2009, many businesses cut back on investment in equipment, technology, and training. Cash flow constraints and uncertainty about the economic future meant firms were cautious, postponing upgrades that could have enhanced efficiency. Banks, constrained by capital requirements and risk aversion, were reluctant to lend to businesses, particularly small and medium enterprises. These firms often drive innovation and productivity growth, so the credit freeze had a lasting effect on the economy's ability to modernize and expand output. Low business investment. Investment is a key driver of productivity, and post-crisis investment levels in the UK remained low relative to pre-crisis trends and compared to other advanced economies. Businesses prioritized balance sheet repair over expansion, while uncertainty about Brexit and global trade further discouraged long-term capital spending. Even as credit conditions improved, investment in machinery, digital technologies, and skills lagged behind. The result was an economy that was able to maintain output by working more hours, but not by producing more efficiently per hour worked. Sectoral shifts and structural challenges. Another factor in productivity stagnation was the structural composition of the UK economy. The post-crisis recovery relied heavily on the service sector, particularly finance, professional services, and public administration. While these sectors contribute significantly to GDP, many are less productive than manufacturing or technology-intensive industries. The UK's decline in manufacturing, from roughly 10% of GDP in the early 2000s to even lower levels today, meant that high productivity sectors were underrepresented in the economy. Additionally, some service sectors, such as hospitality, retail, and healthcare, are labor-intensive and have limited scope for rapid productivity gains. This structural imbalance contributed to slow overall productivity growth despite strong GDP recovery. Regional productivity disparities. Productivity stagnation was not uniform across the UK. London and the South East, home to finance and high-value professional services, continue to exhibit relatively strong productivity growth. In contrast, northern regions, Wales, and parts of Scotland lag behind, reflecting the long-term consequences of industrial decline and underinvestment in infrastructure and skills. These regional disparities exacerbated inequality and constrained national productivity growth. Policy interventions at the national level often struggle to bridge these gaps, leaving certain areas trapped in low productivity cycles. Labor market effects. Weak productivity growth had direct consequences for workers. When output per worker is stagnant, businesses are limited in their ability to raise wages sustainably. Indeed, post-crisis wage growth in the UK was unusually slow, even as employment recovered. Many households experienced a job-rich but wage-poor recovery. People were working, but their incomes were not rising in line with historical expectations or cost of living increases. This disconnect between employment and living standards created frustration and fueled political debates over fairness and economic opportunity. The role of technology and skills. Technological advancement is often a key driver of productivity growth, but the UK's adoption of new technologies was uneven. While some high-tech firms embraced automation, AI, and digital transformation, many SMEs and traditional industries lagged behind. Skills mismatches further exacerbated the problem. Workers often lack training in emerging digital and technical fields, limiting the economy's ability to fully leverage technological opportunities. Government programs aimed at reskilling were slow to scale, and private sector investment in employee training remained modest. Policy implications and challenges, the stagnation of productivity after 2008 raised questions about economic policy. Monetary and fiscal interventions had stabilized output and employment, but they were insufficient to address deeper structural challenges. Policy solutions required long-term strategies boosting investment in infrastructure and technology, improving education and skills training, and encouraging innovation in high-productivity sectors. Without these measures, the economy risked a prolonged period of slow growth, low wages, and widening inequality. Lessons from the productivity puzzle. The UK's post-crisis productivity stagnation illustrates several important lessons. Crisis interventions can stabilize output, but not necessarily raise efficiency. Monetary and fiscal stimulus helped prevent deeper recession, but did not automatically translate into higher productivity. Structural reforms are essential for long-term growth. Investment, technology adoption, and workforce skills are crucial for improving output per worker. Regional and sectoral imbalances matter. National averages can mask significant disparities in productivity and living standards. Wage growth depends on productivity. Without gains in efficiency, households cannot see sustainable improvements in real income. Understanding these lessons is essential as we explore the longer-term consequences of the financial crisis, including rising debt, inequality, and challenges in public services such as housing and healthcare. In summary, the UK's post-2008 economy struggled with weak productivity growth despite monetary and fiscal interventions. Low investment, sectoral imbalances, regional disparities, and skills mismatches all contributed to the productivity puzzle. Deindustrialization and the rise of financial services. The story of the UK economy since the 1980s, and especially after the 2008 financial crisis, is a story of structural transformation. Manufacturing, once the backbone of British economic strength, has steadily declined. In its place, financial services and other service sectors have expanded, reshaping labor markets, regional economies, and the trajectory of growth. In this chapter, we will explore the causes and consequences of deindustrialization, the rise of financial services, and how these trends have influenced productivity, inequality, and regional disparities in the UK. The historical context of deindustrialization in the UK did not begin in 2008. It has been unfolding for decades. From the late 19th century, Britain was the world's manufacturing powerhouse, leading global industries such as textiles, shipbuilding, steel, and automobiles. By the late 20th century, however, competition from emerging economies, technological change, and policy decisions accelerated the decline of manufacturing. Factories closed, regional economies in the North and Midlands suffered, and many traditional industrial communities faced long-term unemployment and social disruption. By 2007, manufacturing accounted for just over 10% of GDP, compared to nearly 25% in the 1970s. This shift was accompanied by a rise in the service sector, particularly financial and professional services, which became concentrated in London and the Southeast. The rise of financial services have been the most dynamic sector of the UK economy in recent decades. London emerged as a global financial hub, attracting foreign investment talent and international banking operations. Investment banking, insurance, asset management, and trading became central drivers of GDP. While finance created high-paying jobs and contributed significantly to national output, it also concentrated wealth geographically. London and surrounding areas prospered, while many regions outside the southeast experienced slower growth. Financial innovation further amplified the sector's influence. Complex financial instruments, derivatives, and securitized products drove profits and asset growth, but also increased systemic risk, as the 2008 crisis revealed. Implications for employment and skills. The shift toward finance and services has reshaped the labor market. Jobs in high-value financial services require advanced skills, education, and often long hours, benefiting a relatively small, highly trained segment of the population. Meanwhile, manufacturing jobs, traditionally stable, unionized, and well-paid, have declined. Many displaced workers struggle to transition into new sectors, especially in regions with limited access to education or training. The result has been widening income inequality and labor market polarization. High-paying finance and professional jobs in cities versus lower-paying service sector jobs in other areas. Regional disparities, deindustrialization, and financialization have exacerbated regional economic disparities. London, the Southeast, and other financial centers benefited from rising wages, investment, and property values. Conversely, Northern England, Wales, and Scotland have faced stagnant wages, slower job growth, and weaker productivity. The effects extend beyond the economy. Regional disparities influence social outcomes, including health, education, and life expectancy. Policymakers have long struggled to bridge the North-South divide, and the post-crisis economy highlighted the persistence of these structural imbalances. Productivity and sectoral differences. The rise of financial services contributed to GDP growth, but had mixed effects on productivity. Many financial activities generate high value per worker, but productivity gains in finance do not always translate into broad economic growth. In contrast, traditional manufacturing offered scalable productivity improvements